By now, we have all been told to keep on investing in index funds for 30 years to have a chance of becoming a millionaire in the future. While that might be true, do millionaires really invest in index funds? In this video, we will take a look at different net worth groups and which assets do they really own. But before we get started, think about how much you want your net worth to be in the future. Great, let's take a look at what assets you should start focusing on. This chart from visualcapitalist.com says it all. As you can see, the different tiers of net worth have very different looking allocations in different assets. But what are these different assets? Liquid means assets that can be easily converted into cash. In this case, we are mainly talking about cash, but you could also consider other assets liquid if you are certain that you can convert them into cash quickly and easily when needed. You have probably been told to have an emergency fund equal to 3 to 6 months of expenses, so if something happens, you are able to pay for it. This is why the lowest net worth tier of $10,000 has such a large percentage of their assets liquid. As your net worth increases, you don't really need that much liquid cash unless you have a lot of debt. Let's say that your net worth is $10,000 and you have $1,000 in cash. In a chart, it would look like this. Now let's say that you are a billionaire and have $1,000 in cash. It looks like this. A billionaire would have to have $100 million in cash for the bars to look the same, but nobody needs to have $100 million in cash just in case something happens. Owning cash is pretty useless, besides having an emergency fund. With current interest rates and inflation, your money is just losing its value if you keep it in cash. The biggest proportion of the lowest net worth tiers assets is the primary residence. It's actually kinda low in percentage, but it can be explained by the fact that the net worth is your total assets minus total liabilities, so the lower your net worth is, the less you have most likely paid off your mortgage. So people with a 10k net worth can live in houses that are worth hundreds of thousands. That just means they also have hundreds of thousands of mortgages left to pay. While the primary residence is one of the assets that will not make you really any money, it is important to choose where you want to live. Living in a nicer house as the net worth increases is something most of us desire, yet we shouldn't have too much of our net worth tied into just primary residence. I'll just say that you should live well, but don't buy a mansion immediately when you become a millionaire if it takes 90% of your net worth. The second largest proportion of the lowest net worth tiers assets is vehicles. This is again something that declines in percentages as your net worth increases. The $10,000 net worth tier even has more of their net worth in vehicles than they have in investments. For smaller net worth tiers, owning a regular car that you use in your everyday life will already take a huge percentage of your net worth. For a billionaire, owning a couple of sports cars can be barely seen in their net worth. Vehicles are something that will not make you any money, so you should avoid spending too much money on them. The next thing on the list is retirement, meaning pension, IRA, and 401k. Because there are limits on how much money you can put in for these, for example, employees can contribute up to $20,500 to their 401k plan for 2022, there is also a limit on how much these can affect your net worth. Retirement makes a huge part of net worth up to those with $1 million net worth, but after that it starts to decline. If your plan is to become a millionaire slow and steady, and you want to work your whole life, then you should max out your retirement plans for as long as possible. If you plan to retire early, there will be a 10% income tax penalty for withdrawing your money before age 59 and a half. So if you plan to retire at the age of 40, you might want to invest your money in some different assets instead of retirement plans, but overall they are a great place to put your money. Life insurance is something that all of the net worth tiers have, but it is a small percentage for all of them. Since it is a small percentage, I will also keep this short. Is it worth getting? Well, this depends on where you live. While it seems like a waste of money to pay for something that you might never use if you live long enough, it might provide financial security to your family if you die unexpectedly. If you are single with no dependents and have enough money to cover expenses related to death, there isn't really any reason for it. Okay, now we are ready to move on to those assets that the higher tiers of net worth own more. Let's start with mutual funds. As you can see, all of the higher tiers have a large percentage of their assets invested in mutual funds. So yes, millionaires and billionaires really do invest in index funds, at least hopefully most of these are in index funds and not actively managed funds, because it is proven that index funds perform better than those that are actively managed. Especially those that have a net worth of around $10 million to $100 million seem to have a huge percentage of their net worth in mutual funds, so if that is the net worth group you want to be in, it's time to get started with index funds. For more information about that, you can check my other video in the top right corner. But it looks like all the personal finance gurus on the internet are not completely wrong. Invest passively in S&P 500 and over a long period of time you will make huge profits. Next on the list we have stocks, and in this case we are talking about individual stocks. Even though many mutual funds invest in stocks, those are included in the mutual funds category, and this category only includes the investments made into individual stocks. Owning stocks increases as the net worth increases. Again, the largest percentage is at around $10 million to $100 million. With the higher net worth, it is likely that investors might have more knowledge about different companies, or they could be investing in companies that are not publicly traded, so they could be owning stocks of companies that they have founded or are angel investors, for example. If you're just starting to invest, I would recommend sticking with index funds, but when you get more into investing, know how to analyze companies, and perhaps want to take risks to outperform the market, then you should consider investing in stocks. Time to move on to fixed income investments. These are securities that pay fixed interest until the maturity date. For example, a government bond could pay you 2% interest per year for 10 years, or a company could pay you 5% interest per year for 5 years. At the higher tiers, fixed income investments are noticeable, but not a very huge percentage of the net worth. This could be explained by the fact that interest rates have been pretty low recently, so there haven't really been any reasons to invest in fixed income securities. Fixed income investments are more like a way to protect your money. It is smart to put some of your money in fixed income so you are not losing all your profits when the bear market happens. It is better to make that 2% per year from bonds than to lose 50% in individual stocks during a bear market. So consider investing a small percentage of your net worth into fixed income assets. Alright, 3 more to go and the best is yet to come. But before I tell you that, make sure to hit the like button and subscribe for weekly videos that help you improve your personal finances. One way to do that is manage assets, meaning that you are giving your money to investment trusts to make you more money. Investment trusts pool investment funds together and earn income for those that have invested in them. Managed trusts are used especially by those that have a net worth between $1 million and $10 million. Trust companies basically act as a fiduciary, meaning that they act on your behalf but won't take advantage of you. This is especially useful for those that don't have knowledge about investing and the financial markets, or for those who just don't want to make their investment decisions by themselves. Besides investing in companies and bonds, investment trusts can also more easily invest in infrastructure and commercial property than individual investors. Next on the list we have everybody's favorite, real estate. It seems to be especially popular for those that have a net worth of $1 million to $10 million, and after that it starts to decline. This could be explained by the fact that with $1 to $10 million, you can easily keep track of all the real estate that you own, you are able to maintain them, and so on, but if you are a billionaire, you could invest in so much real estate that it is not worth the hassle anymore. It's hard to imagine all of the richest people on earth dealing with their tenants and maintaining their properties. But at the lower net worth tiers, real estate is one of the best ways to boost your wealth. Especially with the low interest rates, owning real estate can be a great way to make money, as the price of houses keeps on increasing, while the mortgage stays the same. On top of that, rents keep on increasing, and with the low interest rates, the value of rental income has increased. All of those assets, well, except vehicles, are a great way to start earning money, but there is one thing that separates the very rich people from the lower tiers of net worth, and that is business interests. As you can see, for those that have net worth of $100 million to $1 billion, business interest is over half of their assets. So if you want to become a billionaire, you have to create a business. Well, you don't have to create one, but you have to become part of one. For example, Tim Cook, the CEO of Apple, is not the founder of Apple, yet he has made a fortune thanks to Apple. You could start working in a new startup company and own just 1% of the company's stocks, and when the company becomes successful and finally gets listed, you can sell those stocks for millions. Or you can try the more challenging, but also maybe more rewarding way and create your own business. In 2014, a Finnish company called Wolt was founded. It is a technology company that has a simple idea. People can use it to order food from restaurants, and then the food gets delivered to their doors. The company almost went bankrupt in 2015, but it survived thanks to investors that had faith in it and financed it with around $2.2 million. After 7 years, the company was sold to DoorDash for $8 billion. A simple idea of delivering foods from restaurants had now become one of the biggest takeovers ever involving a Finnish company. One way to boost your net worth quickly is by getting your first 100k as fast as possible. To know more, you can check the video on the left side of the screen. Make sure to leave a like and subscribe, and I'll see you next week with another personal finance video. Have a great day. Bye.